I usually think of you over the years as someone who is optimistic and bullish on the markets. What's your level of enthusiasm right now?
I'm optimistic and bullish when the data suggests I should be. And right now I take more of a neutral to positive view. The valuations are already reflecting the economic scenario that we think is most likely. Economic growth this year, 2.5% to 3%. The current quarter, obviously, the numbers that we just got, robust. But we think the trend in the U.S. is 2.5% to 3%, a little bit weaker this year versus last year in other countries. So that's something that comes into consideration. Right now, the valuations, not just in the U.S. but elsewhere, are reflecting a scenario we think makes sense. So likely gains of 3 to 5% in markets around the world this year.
What about that sort of mini tantrum that we saw from the markets post-Fed yesterday, not getting strong enough hints there about rate cuts? Was that an appropriate reaction?
I think investors need to get into their heads that the period of low inflation, low interest rates, and monetary policy continuing to provide nothing but stimulus is over. Markets instead should be looking at the economy and profits. It's a good picture, and one that we think makes sense. Now, the Fed did not say that they're about to raise rates anytime soon, certainly not. But what Mr. Powell indicated were things that I think should be obvious. Inflation at this level is transitory for a couple of reasons. Number one, those technical factors that are keeping the reported CPI and PCE numbers lower than you would otherwise expect. But more importantly, we're looking at wages rising. And I think that's good news, because when wages rise, the consumer is willing to spend more. We're in a very good situation right now, low unemployment. We have a situation where consumer balance sheets have gotten better, and so consumers are able to spend the wages that they're getting. Now, when I say things are better for the consumer, obviously we know there are some areas of exception.
On the GDP print, we got all those numbers about IP investment. Today we get a nice productivity number. Unit labor costs are down. We know what demographics look like. Why would wage inflation suddenly show itself, given all of that?
Wages begin to rise, of course, when there's less slack in the labor market. The unemployment rate now down well below 4%, and that underemployment rate, that U6 measure that shows us that formerly discouraged workers are coming back into the workforce, that's great news. It's half the rate it was, and so we will be seeing some wages going up. Keep in mind that productivity is the offset. When companies invest in new equipment, when they invest in new IP and so on, that allows each worker to produce more per hour, and it's just fine to pay that worker more.